Ladies and gentlemen, good day and welcome to Yes Bank's Q3 FY 2023 earnings conference call. On the management panel, we have with us today Mr. Prashant Kumar, MD and CEO, Mr. Niranjan Banodkar, Chief Financial Officer, Mr. Rajan Pental, Global Head, Retail Banking, Ms. Anita Pai, Chief Operating Officer, Mr. Ravi Tota, Country Head, Large Corporates, and Mr. Sunil Parnami, Head, Investor Relations. Mr. Prashant Kumar will now give you an overview of the results, which will be followed by a Q&A session. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Prashant Kumar. Thank you, and over to you, Mr. Kumar.
Thank you, and thanks everyone for joining Yes Bank Q3 financial results call. At the outset, I would like to wish you and your families a prosperous new year. With me, I have the top management team of Yes Bank. Starting with the operating environment during the last quarter, Indian economy continued the growth momentum with most of the high-frequency indicators like GST collection, manufacturing and services PMI, consumption, and the capital spending remaining strong. During the quarter, RBI increased the policy rates by 35 basis points and maintained its policy stance as withdrawal of accommodation. Within this backdrop, Yes Bank too continued to pursue its strategic objectives, and in that we have achieved two critical milestones of concluding capital raise and the ARC transaction. We are happy to share with you that Bank concluded the capital raise announced last quarter and received a cumulative infusion of 6,042 crores, which is split as 5,093 crores as equity and 948 crores as warrants application. We also appointed Mr. Sunil Kaul from Carlyle and Ms. Shweta Jalan from Advent as nominee directors on our board. Bank also completed successful assignment of largest pool of stress asset to JC Flower ARC. The details in this regard have been given on slide 13. The bank also selected amongst the first 4 pilot banks for the prestigious Digital Rupee project of the central bank digital currency launched by Reserve Bank of India. The bank also received multiple ESG certifications and scoring topmost highest amongst the banks on S&P Global, CDP rating and Moody's ratings. Now, before coming to our operating performance, regarding yesterday's judgment of Honorable Bombay High Court order, as mentioned in the stock exchange update submitted late last evening, the bank is currently in the process of preparing an appeal before Honorable Supreme Court. Now, specifically coming to Q3 FY23 financial results, bank has reported an operating profit of 914 crores, which is up 16% quarter-on-quarter and 25% YOY. The reported NIMs at 2.5%, they are lower by 10 bps sequentially. However, adjusting for interest recoveries from NPA in the second quarter, the normalized NIMs of 2.5% are flat quarter-on-quarter. The non-interest income at 1,143 crores has grew for 24% sequentially and 56% YOY. And this is led by increase across all lines of business, including retail banking fees and one-off gain on investment in this quarter of fully provided for investment. Our cost to income is of further moderation across most cost heads and came in 70.7% compared to 72.8% in the prior quarter. Our cost to assets remained stable at 2.6%. The bank reported a net profit of 52 crores, largely impacted due to aging-related provisioning requirement during quarter 3. The bank's pre-provisioning operating profit to asset is on track. However, any potential delay in expected recoveries may lower the expected FY23 ROA target. On advances side, our reported advances have grown by 10.4% YOY, of which retail has grown by 43%, SME 19%, mid-corporate 34%, but there has been a degrowth on the large corporate to the extent of 18%. However, after adjusting for the ARC assignment and interbank reverse repo transaction, the normalized advances growth is 12%. The bank expects the advances growth to track the deposit growth going forward. Retail SME, mid-corporate and corporate mix has further improved to 58% for retail and SME, 13% for mid-corporate and 29% for the corporate. Within retail advances, home loans, secured business loans, personal loans and auto loans continue to see strong traction. As you would see on slide 22, each of them, they are at 16% of the retail advances, reflecting granularity. New sanctions and disbursement aggregating to 27,311 crores during the quarter across segments. Despite decline in net advances for the corporate segment, our new business generation continues to be strong. On the deposit side, in spite of the headwind and the challenges, we grew our deposit by 16% YOY and 7% quarter-on-quarter to rupees 2.13 lakh crores. And this is for the first time, it has gone beyond the September 2019 deposit figure of 2.09 lakh crores. The CASA ratio is 30%. Bank continues to maintain its near-term CASA guidance of 35%, but in the current market environment, we are prioritizing and focusing on maintaining the current CASA levels. Average daily current account and average daily saving account balances have grown by 21% and 20% YOY. There has been a significant improvement in the NPA ratios post the ARC deal. GNPA and net NPAs, they are now at the lowest levels since quarter 3 FY19. GNPA ratio for quarter 3 is at 2% against 12.9% last quarter and 14.7% last quarter, quarter 3. Net NPA ratio for the quarter is at 1% against 3.6% last quarter and 5.3% in quarter 3 FY22. Slippage for the quarter, they are at 1,610 crores. However, out of this, there were recoveries and upgrades in excess of 519 crores, resulting in net slippage of 1,091 crores compared to 896 crores in the prior quarter. Slippages out of the standard restructured pool, they were at 190 crores. Around 60% of our standard restructured advances are now out of moratorium. The overdue loans within 31 to 90 days bucket, they are 4,752 crores as compared to 4,500 crores in the prior quarter. The resolution momentum continues to be strong, with total recoveries and upgrades in excess of 1,270 crores. On capital adequacy, the bank's CET ratio has improved to 13%, and the same is excluding accretion due to warrants application money. And the CRAR has improved to 18.2%, and the risk-weighted asset to total asset has improved and is currently at 71%. We have seen a net addition of almost 300 employees during the quarter. All the above points demonstrate a strong momentum in the build-up of a good quality franchise. With this, I want to thank all of you once again for taking the time out for joining this call, and wish all of you and your families good health and a prosperous 2023. We can now open the floor for your questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Mahrukh Adajania from Nuvama Wealth. Please go ahead.
Good afternoon, sir. I have a few questions. Firstly, even after the sale of assets, there has been no impact on NPA. Of course, the capital impact will come next quarter, but the sale of assets, there has some impact.
Mahrukh, sorry to interrupt. There's a lot of disturbance coming from your line.
Hello, can you hear me now? There's no other disturbance whatsoever. I'm on the handset now.
Yes, now it's better. Yeah.
Yeah. So basically, my question was that shouldn't have the sale of loans had some positive impact on margin in this quarter? That's my first question. What would be the outlook for margin for 4Q and 24? And then if you could elaborate any impact that you see from the new ECL circular, and also in terms of SRs. So I know that you had said that the aging continues as if they are your own assets, but own assets as in that it will be based on the revaluation of SRs, or I mean, how will you decide how much to mark down?
So
every quarter, if at all necessary.
Okay. So I think the first question in terms of margins, since the transaction on the ARC that happened in the second part of the December, second fortnight of December. So I think the impact on the margins because of this ARC transaction would be reflected more in the current quarter, that is the fourth quarter of the current financial year. Okay. If you have seen that our retail deposits are growing much better than the corporate deposits, and the average current account balances are growing much faster, both on retail as well as on the corporate side. I think we would continue to work to grow our current accounts and reduce our cost of deposit. Another part, if you see in terms of differential between rate of interest which we offer on our fixed deposit as compared to the larger banks, both on public sector and private sector, has come down significantly. So I think going forward, we would continue to see a control in the cost of our deposits, and with the loan growth, I think we would be seeing an improvement in the margins, not only in the current quarter, but going forward in the FY24. At this point of time, because of, I think, the pressure in terms of the rate of interest, how things are moving, I would not giving any guidance, but definitely this is one area where we need to continuously work and improve. The second part in terms of the security receipts. So I think that on the security receipts, the provisioning requirement, one part is because of the aging. Okay. So since they have to be treated like a loan in your books, so as per the aging, you have to make the provision, and also as per the valuations of SR. So I think that currently the provisioning requirement would be more in terms of the aging.
Thank you.
Got it, sir. And any level of margin you can indicate? And also on the ECL circular, please, if you have any feedback.
Yeah. So sorry, I missed that part. On the ECL circular, since on half-yearly basis, we are also computing the entire balance sheet and P&L on the Ind AS system. Okay. So currently we are seeing that there would not be any significant impact on the ECL circular because the provisioning requirement for category 2 loans would go up. But similarly, the requirement on the category 3 would come down. So I think currently we are not seeing any impact and it would be by and large neutral.
Got it. And sir, when you submit right now, you consider lifetime ECL or 3-year, 4-year, any idea?
So Maruk, I think what we do is depending on whether it's in stage 1, 2 or 3, stage 2 and stage 3 actually assumes a lifetime LGD, but stage 1 is actually over a 1-year time horizon.
Perfect. Thank you so much.
Thank you. Next question is from the line of Kunal Shah. Please go ahead.
Yeah. Hi, sir. So particularly on this entire ARC transaction, if you can explain in terms of in notes to accounts, we have highlighted that there has been a shortfall and it is spread equally over 2 quarters, and the realized profit is considered in this quarter itself of 512 odd crores. And overall, in terms of the provisioning, it is highlighted that the impact of ARC transactions seems to be neutral on the provisioning aspect. So if we can really know in terms of how the transactions have impacted across the provisioning or maybe at the income line item, that would be really useful, yeah.
So Kunal, hi. So that I think 2 things we need to get understand here. So we have about when we sold these assets, the consideration at which we sold was about 8,000 crores for a book which had a carrying value of about 5,000 crores in our balance sheet. And on the date of the transfer, the gross exposure against the 5,000 crore carrying value was about 43,000 crores. And I'm just rounding numbers, for the simplicity purposes. What happens is at a portfolio level, when I have a carrying value of 5,000 with a 8,000 crore consideration, there is the unrealized gain that kind of sits. But given the way the accounting works is, we are unable to recognize that in any shape and form, right, in the balance sheet. But what happens is that we have to look at the accounting from an individual loan exposure level. In the individual loan exposure level, you will have 2 parts where customers, or rather where, let's say, the consideration is higher in some cases over the net carrying value. And there will be other cases where the consideration is lower than the net carrying value, right? So when we look at the first part, when let's say the consideration is higher than the net carrying value, given that it is just a consideration, not yet fully realized, it's a 1585 structure, we are not allowed to book any gain on account of that. However, we receive 15% cash against those exposures. To the extent the 15% cash is exceeding the net carrying value, then to that extent, the bank is allowed to take it into the P&L. On the other side, let's say when the consideration is lower than the net carrying value, that is an amount that we need to adjust or take to the P&L. So I'm just saying these are the two separate ballpark figures that kind of offset each other from an ARC transaction standpoint. And therefore, at a headline level, when we say that there is not been any material impact coming in from the ARC transaction. However, you are referring to the note. So what we have done is that because the 15% cash is a realized cash, it gets accounted for upfront. What we have done is we have basically accounted the unrealized loss by phasing it over 2 quarters, which is basically the 600 crores, and taken the entire hit of that 600 crores through capital. So capital has been fully adjusted. So the CET1 fully adjusts that, but from a P&L standpoint, it has been amortized over 2 quarters. So that's really on the way the accounting has worked for the ARC transaction.
Good. So this 609 odd crores, that is not 15%, that is 100%.
So that unrealized, yeah, absolutely. So let's say the net carrying value of a loan was 50 rupees, and let's say we've sold it at 40 rupees.
Yeah.
So what happens is that the delta, 10 rupees is something that we have to take upfront, and we will basically have to record the 40 minus the 15% cash, in our books as security receipts.
Yeah. So that 6 rupee which is there, that is not adjusted in 10. It is actually 10 which is provided upfront, and 6 is just knocked off. So 609 is gross. 512 is equivalent to 15% cash receipt, which would be
so let's say,
that would be equivalent to 3,400 odd crores of exposure. Yeah.
Yeah. So just to complete, absolutely right. Just to complete. So the 500 is basically where, let's say the carrying value is 0, consideration is 10. Let's say we get 15% cash, so 1.5 is the cash. So 1.5 is what basically gets recorded into P&L. So that's the P&L on the positive side, whereas on the negative side, as you said, like we discussed in the earlier example, that 10 becomes a loss.
Okay. So just last thing on this. So when we say final consideration of 8,046, we can assume 609 is the shortfall, 3,400 as a gross of 512 value. That is where there would have been some gains, and balance is something which is just lying in the book, and we would have created some provisioning against it.
Yeah. So if you actually look at our security receipts, right, the face value of the security receipts are 6,800 crores. Right? And if you actually see the carrying value of the security receipts, right, I'm just again rounding numbers, is about 3,800 crores.
Yeah.
So the delta that we are talking about is something that we are not allowed to take into P&L.
Okay.
Only happen as the realizations play out on the security receipts, and potentially the realizations could also be in excess of 6,800. But yes, as and till the time I basically keep realizing, I will first keep reducing the value of the SR at an individual level, and once that SR is redeemed, any cash that goes over and above that comes into P&L.
Sure. And the overall provisioning, so when I have to look at it, the overall provisioning, that is in investment depreciation and the NPA, so all this, does it relate to the same ARC transaction, or this is different? So any provisioning outside of ARC which is there in the book which is leading to higher provisioning during the quarter?
So again, if you actually look at our slide which gives the breakup of provisioning, that's slide 12. Yeah. At a very substance level, what we have is that the 3,000 crores was a gross provisioning release coming in from NPAs, right? And that has actually been used to step up provisioning on the security receipts for 3,000 crores. That's the consequence of the transfer of the ARC asset. However, the reason the provision for non-performing advances is actually lower and does not entirely correspond to 3,000 is because of the 850 crores of aging related provisioning that we had to take. There was a provisioning implication on aging, as well as for the slippages that happened during the quarter, we had to take the provisioning. So a substantial part of that is coming in from the non-transaction related provisioning.
Okay. So this should ideally have been 2,900, but it is lower 2,000 because of this 850 odd crores of aging and fresh slippage provision.
That's absolutely right. And what you will also see as a consequence of this, so there are two elements that get reflected. One is the fact that we've received a cash of 1,200 crores. That clearly brings down our NNPA. But importantly, also the fact that we have also stepped up the provisioning means that the aggregate net carrying value of the SRs and NPA on a stock basis has come down from 3.8% to 3.3% of advances December over September. And that's also something we've put out on one of the slides, which is slide 13. So, this provisioning essentially has helped us get a substantial part of the drag, 80 basis points lowered in one quarter.
Thanks. This was useful, yeah.
Thank you. Next question is from the line of Sri Karthik from Investec. Please go ahead.
Hi, thank you. A couple of questions. One, continuing on the 850 crore slippage and provisioning requirements. Could you break that down into your steady state slippage related provisioning costs and what was required for legacy aging? Or is the 850 crores entirely steady state as per your current balance sheet goal?
So, Karthik, the breakup of this 850 is about ballpark 250 is on account of the new additions of NPAs that we would have had. The balance pertained to the stock of NPAs that we were carrying. In fact, some of the aging provisioning we also had to take on account of loans that were eventually sold to the ARCs because the sale happened sometime in the latter half of December quarter. But let's say the substandard would have moved to a D1 or a D1 to a D2 during the quarter prior to the sale. So the combined effect of that is what we are seeing as 850. But as I mentioned, the slippages broadly have constituted to about 250 crores of provisioning during the quarter.
Assuming no assumption changes, so next quarter 250 for business as usual and 300 residual from the ARC transaction. Is that how we should think?
So, Karthik, basically there is an aging related provisioning that will come up between, let's say, March and even will follow through fiscal 24 as well. So I would say about a 250 was elevated provision cost for Q3. We would realistically see that in the range of about anywhere between 175 to 200 crores. And on the aging related provisioning, of course, it is noisy because what happens is in one quarter, there might be some accounts that might just slip into a D1. There might be some security erosion that plays out. So I think it's difficult to kind of model that. Hello?
Yes, sir, you're audible.
Okay. So it's difficult to model. So on a steady state, we would say that a 200 is what the slippage new formation of NPA should give us as a provision. And on the aging related, we are very confident that our resolutions and recoveries should be able to offset a large part of those provisions. It's just that many a times, it's difficult to be precise with the timing of the aging related provisioning along with the resolutions and recoveries that plays out. I'm sorry, I'm not sure if...
So the line for the participant dropped. We move on to the next
see.
participant.
Okay,
The next question is from the line of Jay Mundra from B&K Securities. Please go ahead.
Yeah, hi sir. Good evening and thanks for the opportunity. Question on this net security receipts book value of like 3,772 crores. And you mentioned that the provisioning here would be on, let's say, as if this is the loan. So what could be the category of these SRs as of now? Would they be like D2 or, and very quickly they may be falling to D3? Because they should be counted as if, they would have become NPA when they were loans, right? Is that understanding right?
No, absolutely. This understanding is correct. But I think on this security receipt portfolio, it is a mix between the substandard D1 or D2. Okay? Because there were also accounts which were in SMA 2 category, which have been also sold to the ARC. So there are accounts which have become NPA in the current month only. Okay? So they would remain in the substandard category. But there are accounts which are there as a D1. Okay? Because the accounts which are in D2 and D3 kind of thing, they have already been technically written off.
Right. But sir, this considering the operating profit that we have, this, let's say if this is anywhere between D1, D2, the aging related provisioning could be high as compared to the quarterly operating profit that the bank generates. Right. So a lot depends on the cash recovery that we do out of the extended pool. So I don't know if it would be very helpful if you have, some view on the, let's say maybe on a 4-quarter basis, what could be the aging provisions out of this portfolio? May not be every quarter, but let's say 4 quarters from now, and what could be the aging provision for the next 4 quarters?
So Jay, let me just respond that by saying that a good benchmark for what the resolutions or recoveries could be is actually what has culminated as through the JC Flower transaction, right? So, like we mentioned, the actual face value of the security receipts is 6,800 crores, and we are actually carrying them in the books at 3,800 crores, right? Now, what this means is that assuming that the resolutions or recoveries happen, there is a potential P&L write back that will happen on the underlying loan. So just to, again, I'm taking an example. Let's say in one of the loans, there is a profit that comes in because of a higher realization. We are not only recognizing the P&L, but also the principal of that particular security receipt will go down. Right? So what we are essentially seeing is that out of the 3,800 crores, and I'm just putting a number right now, let's say 50% of the security receipts, we are able to realize 100% of the profits. That profit will substantially be used to effectively take care of the aging related provisioning of the residual 50%. And this in many ways is no different from how this has actually played out for our NPA pool as well, right? Because over a period of time, last 2 years, various NPAs have aged. We have taken NPA provisioning. I mean, from a peak NNPA ratio of 5.9%, we've actually come down to 3% on a combined basis, right? That's like 300 basis points reduction. Now, it has had a journey which has seen a step up through aging related provisioning, but it has also seen a journey where we've seen resolutions and recoveries. We expect that to continue. It's just that we may not be able to be precise about the timing of it.
Right. Okay, so maybe the related question is that till last quarter, outside of ARC, we have had a 5,000 crores kind of a recovery target, right? And now this SR sits in our bank, right? Whereas most of the portfolio has already gone to JC Flower. What could be your, let's say, 12 months recovery target?
So I think maybe the loans have moved to JCS, but I think last 3 years, if you see, we are continuously making the recoveries and upgradation to the tune of more than 5,000 crores. So I think in the FY24 also, we would be seeing the recoveries and the resolution on the similar line. So it means like FY24, definitely the recoveries and the upgradation would be more than 5,000 crores.
Right. Understood. And secondly, on sir, Yes Bank reconstruction scheme, right? So correct me if this scheme or the lock-in is getting lifted in somewhere in March, or does it go to April? And then while this would be a secondary market, deal wherein at least around 40% of the holders will have the lock-in lifted. Would you have any comment to sort of an offer at this stage? This is your discussions, or this is your view.
So lock-in would be lifted on 13th of March. Okay, this is a date, right, identified date, and this lock-in would be lifted automatically. There is nothing to be done from the bank side. Okay,
right.
I think our discussion with the investor banks give us that confidence. Okay, that there would not be any pressure on the selling side of our stock post lifting of the lock-in as on 13th March.
Right. Okay, and last two questions, sir. One is, there is a stressed telecom exposure, and media reports have given any figure from, I don't know, from 3,000 crores to 5,000 crores. If you sort of can clarify, how much is the provisions, and if you have any sort of a contingent provisions on that exposure, and what could be the nature of that exposure, funded, non-funded, etc.
No, I think like as a policy, we don't talk about the individual exposures. Okay. Yeah.
Jay, what we can definitely add here is that we've seen a 60% reduction in the exposure over the last 12 months.
Okay, right. And lastly, sir, on if you have the RWA number in rupees crore, that would be helpful. And just the 81 treatment, let's say worst case. I mean, what could be the worst case that let's say you may have to sort of create a P&L liability through P&L, or this could just be, I mean, because this is unprecedented, what could be the worst case outcome on this 81 bond judgment?
So, Jay, I think in the worst case, it would result into actually the CET ratio coming down, CET capital coming down, and the 81 going up by the equivalent amount. Right. We need to see in terms of real accounting system, because this is something where first we are making an appeal in the Honorable Supreme Court. Okay, but I think from the accounting side we need to figure out. But the end result would be a coming down of CET and 81 going up by the similar amount.
Right, sir. And if I can get the RWA number in rupees crore, and also if you have the loan mix by EBLR, MCLR, fixed rate, etc.
So the RWA is 2,43,000 crores.
Sure.
Yeah. And mix, just bear with us, or we will just mention that number.
Sure. Thank you, sir, and all the very best.
Thank you.
Thank you. A request to all the participants, please restrict to 2 questions per participant. If time permit, please come back in the question queue for a follow-up question. The next question is from the line of Shri Karthik from Investec. Please go ahead.
Well, thank you so much again. My line got cut off. I had a couple more questions follow up to the earlier one. When I look at our SMA movement in the non-retail segments along and, triangulate that with the slippages during the quarter, it appears as though our corporate slippages continue, our ballpark 960 odd crores, but the commensurate overdue loans on the corporate side have not come down by the same amount. So it looks like we are still adding higher corporate loans to the SMA pool on a sequential basis. Is that the right conclusion from all this?
So I think if you see the SMA2 has come down, okay, but there has been an increase in the SMA1. So in sometimes what happens because of the number of days in a month, the delinquencies goes beyond the 30 days, okay. But when we see the individual accounts which are coming into the bracket of SMA1, we are not seeing that kind of the concerns around this.
Understood, sir. And the second question is to Niranjan. So on the DTA unwinding into the CET, while our internal accruals have not really have been high, but theoretically, are you seeing the accrued tax losses convert into CET1 as we continue to remain profitable? Is that happening on an ongoing basis?
That's right. I think it's, given the number of profit that we're seeing, it's a smaller proportion, but as this picks up, we can apply a factor of 1.1 to the pickup.
Okay. So 150 bits because of full conversion plus some amount of conversion from the DTAs is the eventual likely CET1 ratio where things once stabilized.
That's correct.
Okay. Thank you. All the best.
Right. Just a quick response to an earlier question that was asked on the mix. So the EBLR mix is about 29%. The MCLR is about 23%. So that's the mix of the advances that we have. Excuse me.
Thank you. The next question is from the line of Sankalp Jain from SBI Mutual Fund. Please go ahead.
Thanks for the opportunity, sir. My question is with respect to the judgment that came out yesterday. Now, since these bonds are perpetual in nature, can there be a thought about not exercising the first available call option? Or does the judgment require you to redeem the bonds 6 weeks easily?
So I think we missed the last part of your conversation. Can you please repeat?
Okay, so my question is that since these are perpetual bonds, do we need to exercise the first available call option, or does the judgment require you to redeem these bonds immediately?
No, so basically the judgment is not talking about any of those things. Judgment is only saying that our notification related to write down of 81 is not upheld by the Bombay High Court. Okay? But these are the perpetual bonds, okay? And it is not mandatory to exercise that call option.
Sure, sir. And sir, second, does the judgment require you to make payment for previously due but unpaid coupons that we have not paid since FY20, or can we still use the coupon discretion clause and not make the payment?
No, so I think again, judgment is not talking about all those things. But I think as per the regulations, this is again the discretion of the bank for payment of the coupons. Okay? And there is no, say, cumulative nature of payment of the coupon. And in a financial year when the bank is in losses, the bank cannot pay the coupon.
Sure. Thanks, sir. That's all from my side.
Thank you. Next question is from the line of Divyansh Karla from Shaurya Capital. Please go ahead.
Yes, sir. Thank you for the opportunity. Sir, I just wanted to understand the reduction. So if you could help us with the breakdown of the reduction in GNPA from Q2 to Q3. So from 27,000 CR. Yeah. So let me just, yes, sir.
Gross NPA reduction
from 27,500 to 4,000 approach. Yeah.
So if the question is how has the gross NPA come down so much from 27,000 to about 4,000?
Yeah. So if you could help with any breakdown, so what was the transfer to ARCs or any contribution? So if you could help us with numbers.
This is substantially a function of the ARC sale, where we have sold NPAs of approximately approximately 23,000 crores to the ARC. So I think it's a function of that where you're seeing the substantial reduction.
Okay. And sir, my second question was a shareholding related question. So if you could help us with what's the percentage of our equity held by index funds prior to 2020, March 2020. So what was which is as of now locked in? If you could help with the number.
We can't hear you. Can you please repeat? I think voice is not clear.
Devyansh, if I may request you to talk to the handset, will be helpful.
Yeah. Is it better?
No, sir. It's still coming muffled.
Okay. Yeah. Let me just check. Is it better?
It's still the same, sir. Are you on the handset?
Yes. I am on the handset.
So please just make one more attempt. You try to understand. Yeah, please.
Yes. Sir, if you could help with the percentage of shareholding held by index funds as of now, which is locked in.
Shareholding. You are talking about shareholding percentage?
Yeah, held by index funds, which is locked in as of now.
Index funds.
Yes.
Proportion is held by index funds.
Yes.
We don't have that answer handy in terms of the precise index fund holding, but we'll be happy to get back to you separately.
Any rough number, if you could, any rough estimate if you have?
No, actually, the reason I'm not just putting out an index number is because many a times you will have institutional shareholding names appearing which get clubbed, but the underlying portfolios represent index funds. So at least I don't have the number that carves out the index holding.
Perfect. Thank you. That's it from my side.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. Next question is from the line of Mohit from Individual Investor. Please go ahead. Mohit, may I request you to unmute your line from your side and go ahead with the question, please? Due to no response, we move on to the next participant. Next question is from the line of Suraj Das from B&K Securities. Please go ahead.
Hi, sir. Thanks for giving me this opportunity. Just one question, sir. Most of the question has already been answered. You mentioned about EBLR is 29% and 23% is MCLR. So does it mean that the rest is all fixed, or there is something else also? Just wanted to clarify.
So we have another 4% of floating rate loans which are pegged to not the repo EBLR or the MCLR. So that number is about another 4 to 5%. The balance fixed rate book that we have, typically the fixed rate book is also comprising a 10% fixed rate book, which represents, let's say, short-term nature of facilities, right? So while these are inherently fixed rate, it's just that they get repriced given the short-term nature of the book. So I think you should also be mindful of that 10 to 15% of the book as well.
Okay. Understood. And sir, also if you can, on the slide 19 in your presentation, you have explained something that 60 basis point of impact from ERC transaction. So if you can just elaborate on this, is it because that you had taken that full impact in capital as you mentioned in your opening remarks, or there is something else?
No, so the impact actually comes from two broad fronts. One is when the NPAs get substituted as security receipts in the balance sheet, albeit at a lower value adjusted for the cash that you receive. The risk weights that get applied on NPAs versus the risk weights that get applied on a security receipt, that is where there is a higher RWA on the balance sheet, right, on a like-to-like basis. So that is number one. The second impact is, excuse me, on account of the deferred tax asset implication on the CET1. So what happens is, for the loans that we have transferred, we have to undertake write-offs of the residual provisioning. So it does not have a P&L implication, but because we have to write off the provisioning in our books, from a tax perspective, it becomes a tax expense and also results into a tax loss. So what the color of the deferred tax asset which is sitting in the balance sheet actually gets substituted from a deferred tax for provisioning to a deferred tax asset for a tax loss. And as a consequence, there is an implication on the amount of allowable DTA that we can carry in the balance sheet for the CET1 computation. It gets lowered because the deferred tax asset from provisioning moves to a deferred tax asset for loss. So that combination of the two, the higher risk weight and the deferred tax asset, broadly was about 60 basis points.
Okay, understood. So, sir, I mean, all the impact has been done, I mean, has been taken once in all, or, I mean, there could be, further some, impact in coming quarters, or there could be some reversion due to this DTA, calculation and all that. I mean, just wanted to understand.
So on the CET1, very emphatically, the full impact of the transaction, has been taken into effect. However, like we discussed earlier on the call, for the security receipts which are outstanding, potentially, like the NPAs in the normal case, there will be an aging-related provisioning that could come through, which will flow into P&L, and therefore, let's say, therefore have an implication on CET1. Or, let's say we could also have resolutions, which means write back, which could also be additive through the P&L. So, I'm just trying to, just be very technically correct here to say that the transaction has got fully baked into the CET1. However, the performance of the security receipts will play out over the next few quarters, years in terms of either a P&L write back or the aging related provision.
Okay, understood, sir. Very clear. Thank you so much, sir, and all the best.
Thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Manhar, individual investor. Please go ahead.
Hello.
Go ahead, sir. You're
Am I audible?
Yes, sir.
Yeah. Good evening, sir. So actually, I'll refer page number 37 of the investor presentation. So there we have 8,853 crore of security receipts, and this is actually the consideration amount, I think, in my understanding. And this is having a net book value of close to 5,000 crores. And then against that, it's mentioned 5,000 crore of provisioning. So is this that the entire book is provision?
Sorry, I think we're just trying to be on the same page. Just give us a moment.
Okay.
So can you just quickly repeat the question? So you were mentioning.
So 8,853 crore of security receipts, has been mentioned there on page number 37 in other non-performing assets. Okay. And the net book value of this is close to 5,000 crore, and against that there's a 5,000 crore of provisioning amount. So is it that the entire book is provision?
No. So the security receipts of 8,800 also include the 2,100 crores of security receipts that we were carrying even prior to this transaction. Okay. Post this transaction, which is a 2,100 plus ballpark, the 6,800 crores of security receipts that we've got pursuant to this transaction, that results into an aggregate security receipt face value of about 8,800 crores as of December. What we are saying is that the carrying value of this book is about 3,772 crores, right? And if we were to add this 3,772 crores to the net NPA stock of the bank, which is 1,973 crores, That gives us basically a 5746 crores of number, which we can compare to the September number as a 7242 crores. Because, at that time we did not have the ARC transaction. So the substantial part of the ARC book was sitting in the NPA. So just to make a comparison, with apples to apples, we've basically shown the number of 7242 in September can compare with the 5746 in December. What we are saying is that if you look at that number as a proportion of the advances aggregate number, that has come down from a 3.8% to a 3%. So I think that's the sum and substance of what we are trying to communicate.
Okay, so my last question is just on the restructured book. So we can see continuously there's 190 crores of slippage this quarter, 140 previous and 120 previous. So, so now that it's come out of moratorium, is that they move into, different buckets, SMA1, SMA2, SMA3, or they remain in the restructured books as it is?
Just 1 minute. Okay, you're saying restructured book.
5,800 crore of restructured book.
Yeah, so the restructured book, which is split across, DCCO, MSME, COVID. So I think that book is holding up quite okay. I mean, I think we are talking about some nominal numbers that may have moved in or out. There have also been some recoveries that have played out through that restructured book as well. But there is nothing substantial or a trend that we are kind of wanting to use to infer that there is any material damage coming in that book.
No, my question was that does this restructured book, move into different buckets, or does this remain as the restructured book? Does this go to SMA1, SMA2, or does this remain in restructured book, according to the moratorium?
No, so there is no, in at least the presentation that we've put out, there is no overlap between the SMA and the restructured book. But from a regulatory classification, if the restructured book were to be let's say, be overdue, that will get classified as an SMA 1 or 2.
Thank you.
Thank you. As there are no further questions, I will now hand the conference over to Mr. Prashant Kumar for closing comments.
So thank you very much, and I think this has been a very, very significant quarter for us, where we have been able to close 2 transactions, one in terms of capital raise and another in terms of transferring our stress asset portfolio to JCF ARC, which results into a very strong capital base for the bank, 13% CET and overall capital of 18%. And similarly, the GNPA number coming down to 2% and net NPA number coming down to 1%. Now, with sufficient capital, a very strong liability franchise which we have been able to build up, I think going forward this would be the growth phase of the bank, and our focus is on the growth with profitability. So I think going forward we would be in a position to not only continuously demonstrate a good performance both on business and the profitability, but also in terms of giving the return to our stakeholders. So thank you so much.
Thank you very much. On behalf of Yes Bank Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.